Hey guys, so in this video, we're going to learn about a trading system and how exactly you develop a trading system from scratch. A trading system is very important if you are trying to achieve, consistent profitability in the market. So if you want to achieve success in the long run, you better develop a good trading system because it's what determines whether you're going to, succeed or fail in trading. Basically, a trading system is just simply, um, an approach, or rather, it's you as a trader approaching the market with some specific set of rules or guidelines that tell you exactly when you need to maybe buy or sell. They need to be very exact, they need to be very well defined, and they need to tell you the specific conditions that you are looking for in the market for you to determine whether you're going to take a buy position or a sell position. So, for instance, if you want to buy, you need to be able to determine which pair is better off buying, as compared to which pair or which trading instrument, and at what zone in the market is it, best for you to be taking the position. So, all these things the trading system is able to tell you, and it really simplifies your work as a trader. A trading system must also be proven statistically. The importance of having statistics is that it helps you to know whether whatever you're doing works or not. It is very possible to have a system that you have developed and seems like a very good system, but then it still fails. So that's why you need to be able to prove your system on the market using statistics of the past data and be able to show that this system actually works and it has maybe this and this success rate. Also, if it has a greater failure rate than success rate, it becomes very easy for you to know that the system doesn't work and you can change it until you find something that works. So most questions that people ask, for example, what is the best stop loss to use? What is the best take profit to use? What is the best time to buy? Which pair is better off trading? Some people have the question of which are the best pairs to trade as compared to others. And the reality is, no one can give you a specific answer. What you need to do is to develop a system from the market, which you should be able to test using the past data. And it's the system that will help you to determine the best stop loss, best take profit, because it is through you testing the market using the past data that you can be able to realize that maybe out of every 50 or 100 trades, if I use this and this stop loss, it works off better than the other. So that answer cannot be given to you just because, someone feels like, a 10 pip stop loss is better than maybe a 30 pip stop loss. It has to be proven statistically. That's exactly what I'm going to be teaching in this video. So basically, a trading system consists of number one, a working strategy. Number two, it consists of back-tested data. That's where the statistics come in, the proof. Then number three, the trading system consists of specific trading instruments or trading pairs. So I'm saying instruments because not everyone trades, currency pairs. Some people prefer to trade indices, some maybe, metals, etc or some other commodities. So the trading system must factor in all these three things. And I'm just going to be doing a breakdown of each one of them one by one for you to see how it will all add up to develop a working system. So the first thing we're going to start with breaking down the strategy, the working strategy. Yeah? So the trading strategy is just simply the approach that you're going to be using to analyze the market before validating a trade. So, for instance, in Forex trading, we have so many trading concepts. We have smart money concepts, we have support and resistance, market structure patterns, supply and demand, trend trading, trading reversals. So, all of these are very different concepts which do work. Some of them work individually, some of them work when they are combined together, under different circumstances. So, what you're going to realize is before you even develop a trading strategy, you need to first have a very good understanding about the forex markets and how they work. So you see, as I've mentioned all those concepts, so at this point I'm assuming that you've already, maybe studied and you understand all those concepts. So developing a system is not something for maybe a beginner. It's someone who has understood most concepts about trading, but now you just want to perfect and find a specific thing that's going to be working for you. So what I'll advise is, you know, under the many trading concepts, you just need to find maybe one or two concepts that work for you. one or two concepts that you're going to understand very, very well and practice them enough to a point that you can easily identify them in the market randomly and be able to trade them, practically in the market. So now this is very, very subject to, you as an individual. So you'll find that people who prefer trading support and resistance, some who prefer trading only trends, some reversals. So now that I cannot give you an exact answer, it really depends with what you've understood well, what is working well for you, in terms of the knowledge that you have as a trader. So you do need to practice enough most of these concepts until you find one that suits you. And after you find one that suits you, keep practicing it to the point that you can trade it easily and comfortably in the market without any difficulty. Part of choosing your trading strategy, or rather through the practice of you trying to master what is working well for you, you will also be able to identify a specific time frame that works well for that strategy. You'll realize there are some strategies that people apply on the 1 hour time frame, some on the 4 hour, some on the daily, some apply them on smaller time frames as low as 1 to 5 minute, 15-minute time frame. And you can't say one is better than the other. It just depends with what is working for you. You can be a scalper, you can be an intraday trader. So based on the strategy that you're going to choose, through the consistent practice in the market, part of you becoming comfortable to be able to trade it easily is that you should be able to identify a time frame that works perfectly for that strategy. Not all strategies work well, across all time frames. So that's up to you. That's up to you to do your assignment. But in this video, I'm going to be showing you an example of how I do trade. So if you followed me for a while, you do know that one of the concepts that I do trade a lot is the supply and demand. So with supply and demand is very simple for those who are new to it. Anytime we have a market that has impulse and retracements, both on the uptrend and on the downtrend, yeah. So in the market has impulse and retracements, anytime price comes back to the beginning of the impulse, we mark it as a demand zone. Same thing if it comes back here, we mark a demand, mark a demand. Then supply is the exact opposite. So supply is when the market is in a downtrend. So when the price is dropping in a series of impulse moves, meaning we have lower highs and lower lows. In this case, we had higher highs and higher lows. That is the key point, yeah? So for supply, same thing. Anytime price comes back to the beginning of this impulse, we mark it as a supply zone. So that is the approach that I do use to trade the market. The whole point is I am looking to buy at demand and sell at supply. So I'm going to show you a very, very practical example. As you can see, this is just the market. I had a setup here last week. So I'll just show you quickly. For instance, here we did have an impulse move to the upside, a retracement, and another impulse move, and then another retracement. So now, when we do have this impulse move, when the market is retracing, remember the point that I just told you, you come and mark the beginning of the previous impulse as a demand zone, yeah? So how you mark it is you come and use the rectangle. You mark immediately where the move begins to where we have a significant breakout candlestick. So you can use this green bullish candlestick as the significant breakout and extend to the right. So that is a demand. So as I said, I'm looking to buy at demand. If price comes at demand, I am usually looking for either 2 to 3 things. Number one, I am looking for a rejection, because when I get a rejection or a spike, it's a sign that price is getting weaker. So price has been dropping or retracing according to the analysis. When it gets to this price point, you want some sort of rejection, just to indicate that there is some weakness in the momentum. Now, the rejection must not happen immediately here. It can happen anywhere in this zone. It's possible for price to trade all the way to this zone and leave a rejection from this point. As long as price doesn't trade and close strongly below this zone, the zone is still valid. So after the rejection, I do want to get some sort of small pattern, and most importantly, a breakout candlestick. So in this case, we did have some two, not two, we had a number of small body candlesticks, which indicate some price confusion. Then we come and get this candlestick that closes above this neckline here. So when you get something like that, I consider it some sort of small consolidation. If you come and mark, this is a small consolidation and a breakout. So when you do get the breakout, I come and look for my entry at the neckline. So that is exactly how I do apply my supply and demand. I put my stop loss and I do have a take profit somewhere above there. So that is an example of a buying position. As usual, we do want to find some sort of sign of weakness. Here we had several rejections, countable, I think maybe 3, maybe 4. That's a very, very good indication that price, the bulls are getting weaker. After getting the rejection, that's not enough. We still want to get some sort of momentum or breakout candlestick. Then we did come and have this very, very strong bearish candlestick. After getting the bearish candlestick, you can come and have your entry at the neckline, which was all the way above. So what that means is that after price has dropped here, I put my pending order all the way above for a sell position. In the case that you are doubting that position, you can always be more patient. If you check carefully, we had price went up, came down, went up, then we had this final breakout below this neckline. So if you doubted the first one because there was no much significant confirmation, you could still use this second breakout pattern for your entry. So in this case, you do come and take your short position or your sell position at the neckline, have your stop loss somewhere there, and the market dropped. So long story short, that is how you do identify a trading strategy. So now I don't know what concept you trade with, whether it's supply and demand, whether it's support and resistance. I don't know what works very, very well for you, but you do need to find one thing. And the whole key point here is that the strategy must be very, very clearly defined. In fact, you should be able to write your strategy on paper. Yeah, and I can clearly define my strategy. Number one, we need to have a series of impulse moves. Number two, we are marking either demand or supply, whether I'm looking to buy or sell. Number three, I am waiting to get a rejection at the supply zone if I want to sell. If I do want to buy, I'm waiting to get what? Rejection at the demand zone. After getting the rejection, that is still not enough. The next point is that I am waiting for a breakout candlestick or some sort of breakout pattern. That is, I think, number 5? Then the last thing is that I am waiting for price to retest the neckline. So after getting the breakout, I'm still not selling immediately. I'm waiting for price to come back to the neckline. So you see, I have clearly defined the things that must come into play before I can take a position. So part of you identifying your strategy is you clearly having that definition of what needs to happen before you can decide to get into the market. So again, you cannot decide all these things if you still don't have the understanding of Forex. Because of course, for you to be able to understand that you need to identify rejection, I'm assuming that you already understand of the basics and you know what the rejection means, you know what the pattern means, you know what the breakout means, and you also know why it's important or why it's better to get your trade at the neckline as compared to chasing the price down below. So that's step number 1. Now the second part of developing a trading system, is the backtested data or backtesting. So now I consider this probably the most important process of developing a system, because this is where the statistical data lies. You are trying to apply your strategy to the past market data and see how it's been performing over the past months and preferably years. So it's at this point that you can tell whether whatever you're practicing actually works in the long run or not. You'd be shocked that most people in the market are trading with systems that don't work. If you try to backtest that system over 1 year, you realize it was never really profitable. And the worst thing about it is that these people who are using this system that don't work don't have a clue. They don't even know that whatever they're doing doesn't work. So you just think that trading is difficult, but whatever you're doing, you've never even tested it. You're just trying to trade because you understand one concept. Understanding a concept is nice, but you need to be able to put it to the test and get the confidence that it actually works, or also know early enough that the chances of this concept working is quite low. So I'd rather either adjust it or move to something else that works better. So now backtesting is, in the most simplest form, backtesting is just applying your strategy to the past market data. For instance, I've already defined my strategy, so I don't know what you're using to trade. And as I've said, the strategy is very subject to you as an individual, to you as a trader, and what works for you. I'm just using my example of supply and demand here. So I've defined my strategy of supply and demand. So now, after defining all the conditions necessary, you need to go to your chart, scroll back if possible 1-2 years ago, start applying the strategy all the way from maybe a year ago or 2 years, I recommend a minimum of 1 year. At least 1 year is good enough for you to give you some confidence. Then try to apply the strategy and see if I did apply the strategy, maybe out of 1 year, let's say in a year you get 50 or 60 trades. Out of the 60 trades, how did they perform? How many of them, went to profit? How many of them went to stop loss? Also try to figure out how many, like the ones that went to profit, how far did they go? The ones that went and hit your stop loss, or the ones that headed to the direction of your loss, how far did they also go? So all this data helps you to be able to, first of all, determine whether the strategy is working or not. Number two, helps you to determine the best stop loss. And the most common problem that people have is to determine the best take profit. People don't know where to exit the market, so you cannot know all this unless you have data that you have tested. Now here's a very quick example. Yeah, if you check this previous, you know we have an impulse and retracement. Just want to show you the importance of how this data can really help you. Yeah, so if you come and mark this demand zone, for example, again, I'm using my strategy. Price comes here, we have some small rejection, not convincing enough. We have breakout candlestick, we have consolidation and another breakout. After the breakout, I come and take my trade at the neckline, for example, which would be somewhere here. So something that you need to be noting down every time you are doing the back test. I want you to try and see how far did the trade go to your direction. For example, before we had a very significant retracement, we can consider that this trade headed all the way to 262 pips. Then how far did it go in terms of our loss? Close to zero. Yeah. So if you do this consistently, you realize one thing. There are trades that will go as good as 260 pips. There are trades that will even go up to 300-400 pips. But then you'll come to realize that there are also many trades that will do maybe only 80 and 90 pips. Yeah. So based on this data, you're able to determine which take profit could be, optimal, which stop loss could be optimal if I want to be successful in the long run. Yeah. So the whole question where people always ask which is the best stop loss and take profit to use, no one should give you an answer for that. You need to do the back test on the charts, on the market. See for yourself in the past 1 year which stop loss could have actually worked. So the answer to all of your questions lie in the markets. No one can answer that question for you. So when you do your back test, this is an example of some of my back tests that I have done. I've back tested very many pairs, but these are the ones that I do trade often. So, for instance, this is the backtest of Euro AUD, Euro Australian dollar, the whole of 2022, previous year. Yeah, I've done it for so many years, but this is just an example for the previous year because it's the most recent one. So, from my backtest, I can clearly tell that all the way from January to somewhere in December, we only took 39 trades on Euro AUD because we are starting at number 2. Yeah, so from the backtest, I can also determine, I've already done a rough calculation or estimation. So I can already determine my win rate, which was roughly, I think, 70% the whole of last year, specifically on this pair. So that means if I go to the chart and try to apply the same strategy on this pair the whole of last year, try to look at how the market performed, if I could have done the same thing, I should have had at least a 70% hit rate on that specific currency pair the whole of 2023. So also remember that part of you doing the back test is that you should have already determined the best stop loss and the best take profit. Yeah. So after you've analyzed your data, determine maybe I'll be using this stop loss and this take profit. Part of my strategy is that I have already determined most of the stop losses that I do use are roughly 40 to 45 pips. Then my take profit is always roughly 2.5 times whatever my stop loss is. So if I'm risking 45 pips, 2.5 times is roughly 112, 113 pips there, 112.5 pips. So that is usually my target most of the time. Sometimes I'm only trying to target 1:2, meaning if I'm risking 45 pips, I want to target at least minimum of 90 pips. I don't do anything less than 2 times what I'm risking. So now by the time you've done the backtest, you've already realized also the risk to reward ratio, which is very, very important. So under the backtest, it is for you to determine, number one, it's for you to prove the strategy works. Or if it doesn't work, adjust or switch up to another thing. If it does work, next thing you want to determine is the best stop loss and take profit. Because when you are testing, you want to see how far it went against you and how far it went to your direction. If you always come to the market and use the highest take profit, you're likely to have a very difficult time. For instance, there are days that the market would do, for instance, if you look at this point, if you use this, if you test the market from this point, it dropped constantly with about 400 pips before it retraced, continued with about 500, 600 pips. So if you decide to use 500 pips as a take profit every other time, you're likely to have a very difficult time in the market. So that's why you need to have the data and see that there are days it will go 500, there are days it will do 300, there are days it will do only 90. So you try to figure out which is the optimal TP that I'd be using consistently. Also try to figure out which is the optimal stop loss. Of course, you figure out using the statistical data. So you simply do the probability of using this stop loss and this TP versus this and this until you find the one that is most optimal. And the last part is identifying the specific, so that's the keyword, specific trading instruments or pairs. So if you've noticed on my chart, I only have 5 pairs. Of course, DXY is not a trading instrument. DXY is just an index to measure the strength of the dollar. So it's not really um, actively tradable. These are the only 5 pairs that I trade: Euro AUD, Pound, Australian Dollar, Euro Card, Euro and ZNZP Card. So they're all exotics. I trade them most of the time. So what you'll come to realize is if you do your back test, you've already determined your strategy. So you need to test the strategy across most, if not all, trading instruments that you would wish to trade. So from the back test, you'll come to realize on some specific pairs, the strategy is working very, very well. On some of them, it's working poorly. That's a very good point for you to eliminate pairs that are working poorly if you backtest your strategy. And this is where most people go wrong. I see people applying the same strategy on, 13 different trading pairs. Then they wonder why they never hit consistency. I mean, if you have done the backtest and you can prove that your strategy is working across all those 13 pairs consistently, that's definitely acceptable. But most people don't have the data. You just learn one thing and you want to apply it everywhere. You can find a strategy that works very, very well on the 1 hour time frame, like the same supply and demand that I've been showing you. If I do try to apply it on some pairs, actually, by the way, I do struggle with it. I hardly become profitable. But when I apply it on these pairs, on this specific time frame, you see, I become profitable because I have tested it using the past data. So you can find someone trading smart money concepts on the 15-minute time frame. Go try apply the same smart money concept on the 4 hour time frame. You'll see how you're going to struggle. I'm not saying it's never going to work. It will work sometimes, but you'll realize the success rate might change. You might find out that maybe on the 15-minute time frame, the smart money concept was having an 80% win rate. You head to the 4 hour and all of a sudden you have a 60% win rate. And again, the stop loss has to change. Maybe on the 15-minute, you would have used a stop loss of 10, 15, 20 pips. On the 4 hour time frame, you now have to use a stop loss that is maybe 3 or 4 times bigger. Yeah. So all of this you determine through the backtest. That's why I said the backtesting was the most important stage of this of developing the system. So do choose specific pairs, eliminate all those pairs, or rather eliminate all the instruments that have a low win rate. Yeah. At least you should always have, if you're doing a minimum risk reward of 1:2, I suggest anything above 60%. If you can do 70%, the better. If your strategy has at least a 1 to 3 success rate, even a 50% win rate will actually work. Yeah, that is the magic about risk to reward ratio. If you do realize most successful traders, if you check the ones that have proven data, not the one that show you screenshots here, most successful traders you realize have very specific instruments that they trade. It's not because they can't trade other things, it's because they've already realized that it is this specific pair that works better with this strategy on this time frame as compared to another pair or another instrument. So never be shocked when you see someone trading like you find me trading exotics and I hardly trade things like gold and indices like Nasdaq US 30. Then you wonder why is it that if you know how to trade, you cannot trade other things. It's because the strategies are very, very different. And the whole process of learning a strategy and trying to apply it on a pair until it starts working is very hectic. It will involve a lot of ups and downs, a lot of frustrations, to the point that the day you do find something that works for you, you don't even want to be switching it up. You just want to stick to it and profit from it. It's the same thing. You don't need to master everything. You just need to master one thing and stick to it. So anyway, long story short, make sure you identify what works for you. It took me a very, very long time in trading before I realized that a strategy doesn't just work on everything. I used to trade, I learn a strategy, I find that it's actually working maybe on Euro USD. You try to apply it on another pair, but you don't realize that maybe it was only working on the 1 hour time frame. So you've switched it to maybe another pair that is not Euro USD, and you're also trying to change the time frame, then you're wondering why it's not working. So sometimes it works, sometimes it doesn't. But long story short, in the long run, you just don't achieve success. It's very simple. Not everything works across all pairs the same way. So anyway, that is how you do develop a trading system. Please make sure you're not gambling in forex trading. If you don't have a system, sorry to say, but you are engaging in active gambling, maybe consciously or unconsciously. Yeah, without a system, you're guessing. Without a system, you just wake up in the morning and you're just trading based on how you feel. So most of the times you'll hear someone saying, I think this thing is going to go up. It has got nothing to do with what you think. If you ask me where the market is going, I cannot tell you what I think. I just analyze based on the strategy. For instance, you can see this is I'm anticipating the next weekend. I've already marked my zones. Yeah, I've already marked my supply zones and my demand zones. So I don't know how the market will do on Monday. I don't know whether it's going to go back up here, whether it's going to go here or here. But what I do know is that as long as I have marked my zones, I'll just monitor and watch how it behaves and reacts on the zones is what will help me determine whether we do have a setup or not. So there is no gambling, there is no guessing, there is no trading with your emotions and your feelings. You don't wake up and see a candlestick is dropping strongly and you say just because this candlestick is moving like this, let me jump in here for a sell. You need to have a very specific reason why you're jumping in here for a sell. So someone will be jumping here for a sell. Well, on the other hand, I'm here trying to anticipate a buy because what there is a demand zone. So have a very, very specific defined thing that you can practice consistently. It is the consistency that generates profitable results. It's not one good trade. It's not one good week. It's not one good month. It's you doing the same thing that we have proven that is working consistently. If you do come today and trade using supply and demand and you get a good trade, you see you're happy. Tomorrow you come and you start trading with a long candlestick. So you have already switched up the strategy again. So you keep on switching from one thing to the other. So you make money with supply and demand, you go and lose money maybe with trading with candlesticks momentum. Or you make money with candlesticks momentum, next time you go and try to trade support and resistance and you lose. So it's not that this concept doesn't work. You just have to prove that it works, prove exactly the best way that it works, the best conditions for you to find a trade, then stick to it consistently. Don't switch it up always, up and down. Don't do any guesswork. Don't trade randomly. Trade with a system. Finally, after developing a system, you realize one thing. A system covers the whole problem of trading psychology. In fact, if you're struggling with trading psychology, what you need is a trading system that works. For instance, I've already shown you my data. I have roughly a 67 to 70% win rate across my strategies. Now, this gives me a lot of confidence to the point that whenever I'm trading, I don't care whether I hit stop loss or take profit. If the trade hits stop loss, I don't care anyway because okay, of course I do care, but what I do mean is I don't have the fear. I don't have the fear of what if I hit stop loss because if I have a 70% win rate, that simply means out of every 10 trades, I'm looking to lose at least three. So part of the strategy is that I should lose at least three trades. So it has already helped me to factor this in my psychology. So when I see myself hitting a stop loss, I'm not so scared because I'm like, this is just one of the three trades that I'm supposed to lose out of the 10. So you see how it helps you to develop a very, very strong trading psychology, and it helps you to avoid making mistakes, avoid guesswork, and avoid random trading. I hope you do learn something from it and apply it in the best way possible. And just remember one thing: if you never develop a system, just forget about the long-term success. You're simply gonna be gambling. You're gonna have one lucky good day, a lucky week, a lucky month, but you can't do it consistently. And the whole point is to be able to trade consistently and stably. Yeah.